my name is Madison Andre,
I'm Brenda Turcios.
and today we are going to be doing financial analysis of beauty brand industries and fast fashion retail brand industries. We're going to start off by analyzing companies from the beauty brand industry. They're going to be Ulta, Coty, e.l.f., Unilever, and L'Oreal. L'Oreal did have a dip in its liquidities ratios in 2021, but they are increasing those and they are able to pay off any short-term debts with their liquid assets. They maintain an average asset turnover, and it does look like they're using their net fixed assets very well. They are borrowing some money with a financial leverage ratio underneath 2, so they aren't dependent on their debts, but they are using them. And we can see here that the return on assets and the profit margin are over 10, which is great. Most importantly, we have a high return on equity over 20, meaning that we're getting great equity for our shareholders. We have a PE ratio dipping up and down from 2020 to 2024. It's right underneath 30 right now, which would be a great price for a consumer. Return on investment capital is always over the weighted average cost, meaning that the company is creating value. All right, let's take a look at company Coty. So company Coty did decrease and is on the lower end of their liquidity. They may not be able to pay off their short-term assets. They have maintained an average asset turnover in the past 5 years, and it does look like they made some form of investment in their net fixed assets. A notable mention is that they do have a high debt history. In 2022, their financial leverage ratio was above 8. It does look like they were able to decrease that though. And until 2022, that their profitability ratios were even in the positive sector, and it does look like they are starting to dip back down to that 0 line. Considering that they haven't been extremely profitable, their PE ratio is a little high to me. Considering that in the past 5 years, the return on invested capital was never over their average weight, indicates to me that they aren't a very profitable company, and I would not invest. Let's take a look at Ulta. Ulta is on a decent side of their liquidity ratios, an average net fixed asset turnover and asset turnover. They also have borrowed some debt, but they don't seem to be really reliant on it. They did have a dip down in profitability in 2022. They did shoot up, and their profit margins are on the lower end from what we've seen in other companies, but their return on equity is one of the higher ends, being above 60. Their market value in the past 3 years has maintained around 20, which I think is a very fair price, and they have maintained their return on invested capital over the average. So I would suggest considering investing in Ulta. Unilever is increasing their liquidity since 2021, which is great. They do have an average asset turnover and have increased their net fixed asset turnover as well. They are on the higher end of their financial leverage ratio, but it does look like they are slowly starting to decrease that over the past 5 years, so maybe becoming less dependent on their debtors. Had a decrease in profitability in the past 3 years in their ROA, ROE, and in their profit margin, kept their return on invested capital higher than the weighted average, but it does look like in some point in 2025 these are going to meet. So I recommend investing in Unilever. Look at our last company, e.l.f. The liquidity ratios did decrease in 2023 to 2024, but before all of that, they were very liquid. They have also maintained an average asset turnover in the past 5 years, and it does look like they may have made some investment in their fixed assets that have been pretty profitable for them. They do say on the lower end of debt. Regarding profitability in 2021, they did have a significant dip down, but it did significantly increase in the next 3 years. In their profit margins and in the return on investments. Their PE ratios are a little high to me, as it does look like compared to the past 5 years they were decreasing, but it looks like they're on the rise in their return on invested capital compared to their average weighted cost. So if you are willing to take a chance, this is a company that I would suggest taking a chance on. So to review, my recommendations are investing in Ulta Beauty, L'Oreal, or considering taking a risk you might have a great return by investing in e.l.f. Pass this on to Brenda as she does a financial analysis of fast fashion retail brand industries.
So the other industry to analyze is fast fashion retail brands. And the companies we're going to study are American Eagle, Abercrombie & Fitch, Urban Outfitters, Gap, and Guess. And the first thing we want to talk about is liquidity. These caches tells us how much cash or quick money a company has to pay its short-term debt. We can see a clear pattern here that repeats a lot more often, and it's companies like American Eagle, Abercrombie, and Gap increasing their liquidity during the pandemic crisis, and then it slowly goes down again in the following years, only to recover in 2024. This means that in the beginning they were relying on cash and receivables to pay their short-term debt, but shortly after that they had to rely a lot more on inventory, on selling inventory to be able to pay their short-term debt. We like Abercrombie and Fitch the better because by the end of 2024 they were almost recovered. They had a quick ratio and a cash ratio of almost 1, which means that they could easily afford their short-term debt. So another aspect that we want to talk about is long-term solvency. And the first ratio, financial leverage, is telling us how much debt a company is taking. And as you can see at the bottom, taking less risk, which is good, is American Eagle and Urban Outfitters. And then on the other side, we can see EBITDA to interest expense, which means can they afford this debt? And as you can see, we have the purple line again. Urban Outfitters has the highest ratio. However, they also have the most unsteady ratio, which means they may be struggling with their earnings. And this is the reason why we like American Eagle better, again, because we can see that in 2020 and 2024, there is no information in Bloomberg. So that could mean that they had no interest expense or that their interest income was higher than what they had to pay. So that is something positive. We also want to talk about asset management. This means how well is a company managing their assets. And as you can see, there's a clear pattern where all the companies had trouble managing their assets during the pandemic crisis, but they kind of slowly go back up. All of them managed to have a ratio of over 1 in the following years, so that is good. But another important thing to talk about is inventory, because we are in the retail industry. And in the inventory turnover, we can see that Urban Outfitters and American Eagle are doing the best, replacing their inventory and selling it to generate more cash. And they are also taking less time doing so. So we like these companies better again. Now let's talk about profitability. As you can see in the graphics, there's a clear pattern where most companies report losses in 2021 during the pandemic crisis. Then they go back up in a huge recovery, but follow again in 2023, mainly due to inflation and other online competitors like Shein and Temu being in the market. Now, if you see the most important ratio, ROE, which means how much money is going into the shareholder's pocket, we like Abercrombie and Fitch better, and we also like Guess because they managed to stay steady since 2022 to 2024. Finally, we get to talk about the market value. So these ratios are telling us what the company is going to be worth in the future relative to information of the past. So when you see these high peaks here, this information can be biased because for these years, these companies or most companies reported losses, reason why there was no sense in calculating this ratio. And since Urban Outfitters and Abercrombie did report a modest earning and they were able to calculate the ratio, it seems as if they were highly valued, but this is not the case. This is biased. So again, we like American Eagle better because even though they do not have the highest value in the market, you can still buy cheap stock and get consistent results. So what is our final recommendation? Well, we don't think Gap is the best choice because they have the lowest ROA, they have the lowest returns, they have the lowest ROE, and they have high leverage. So this is a risky investment. Guess has moderate ROA and second best ROE. However, they have the second highest leverage. Urban Outfitters has a conservative profile. They have high returns and they have low leverage. However, this is not the favorite company because the market seems to value them as a very unstable brand. Abercrombie and Fitch was a surprise. They have moderate efficiency and a medium to high reliance on leverage. However, they have a very consistent but average long-term results in returns. And finally, our recommendation is to invest in American Eagle because they have the best combination of a strong return and a moderate risk. They are also more consistent in performance and efficiency.